sales of $1.434 billion, a net loss of $61 million, resulting in a diluted EPS of negative 78 cents, and adjusted EBITDA of $59 million.
Yeah, those are the Q2 2026 headline numbers for West Fraser.
Exactly. Our mission today is to unpack this Q2 earnings presentation and the press release. We want to help you make sense of the company's operational shifts and, pretty heavy market headwinds.
Right, and just to establish a baseline here, that $59 million in adjusted EBITDA, that represents a consolidated margin of just 4%.
Which is razor thin.
It is, yeah. In wood products manufacturing, 4% leaves you virtually zero room for error. But in this context, it's actually a notable step up from the negative margins we saw in Q1, so it really signals a stabilization in the business.
Right. The bleeding has essentially stopped at the operational level. But to understand how that top line actually improved from Q1, we need to look under the hood at their segment performance and management's strategic capital decisions.
Definitely. The lumber segment was the real workhorse this quarter. They brought in $41 million in adjusted EBITDA.
Though we should probably mention, $13 million of that was a favorable duty adjustment from previous years, right?
Yeah, good point. So pure operational earnings were slightly lower, but the volume story is what stands out. Shipments of SBF, so spruce, pine, and fir, those jumped 18% sequentially.
Which is a massive jump for a single quarter when end market demand is, pretty flat.
Right, but that volume spike is almost entirely mechanical. It's tied to the restart of their Blue Ridge facility up in Alberta. They brought that mill back online late in the first quarter, so you get this massive sequential tailwind in the shipment data.
Yeah, they finally had the internal capacity to push that volume back out. But the U.S. side of the lumber business didn't have a major mill restart, and SYP Southern Yellow Pine shipments still rose 5%.
Right, and they managed that despite some really severe transportation bottlenecks in the U.S. South.
Yeah, the chronic railcar shortages. So how do they actually push 5% more volume out the door when the logistics networks are choked?
It comes down to modal flexibility. If you're rigid, you just let inventory pile up at the mill, waiting for a train that's 2 weeks late. But agile operators pivot aggressively to flatbed trucking.
Which is structurally way more expensive per board foot.
Oh, absolutely. It hits your margins hard. But in a trough cycle, moving the inventory and converting it to cash is just way more important than optimizing your freight costs. You eat the trucking rate to keep the yard clear and the cash cycle spinning.
Makes total sense. And we also need to touch on the engineered wood products, or EWP segments. North America and Europe each contributed $13 million in adjusted EBITDA.
Yeah, and Europe is actually showing some improved market conditions relative to last year.
Right, but I really want to pivot to the physical footprint.
Yeah.
Because this seems like the real engine of the quarter. Management is aggressively ramping up production at their new Henderson, Texas sawmill.
Oh yeah, production there more than doubled compared to Q1.
Wow. And meanwhile, they successfully wound down the high-level OSB mill up in Alberta, on time and under budget.
Right, and just for quick context, OSB-oriented strand board is made by chipping lower-grade trees into flakes and pressing them together. It's heavily used in roof sheathing, but older mills like High Level require constant maintenance. They run on outdated presses.
Okay, let's unpack this. It's almost like they're pruning a tree, right?
Yeah.
I really like that analogy, actually.
Yeah, you cut off the older, less efficient branches, like the Augusta and 100 Mile House mills they closed previously, and now the high-level OSB mill, so the sap can flow to the strongest, most modern branches like Henderson.
Exactly.
But I have to challenge this a bit. If you're in a 4% margin trough, shutting down a mill looks a lot like defensive shrinkage. Are they just shrinking to survive? Or is there a structural upside here?
It's definitely an upgrade. Think of it like swapping out a fleet of gas guzzlers for electric vehicle. When you run an older mill, a gas guzzler, your operating costs are just structurally high. Your margin for error is non-existent.
Right, lots of maintenance.
Yeah. But building a state-of-the-art facility like Henderson is expensive up front. But once it's running, your marginal cost to produce every single board foot drops dramatically.
So by shutting down high-cost mills and ramping up low-cost ones, they are intentionally lowering the overall average cost of production across the whole portfolio.
Exactly. You don't control the commodity price, but you do control your position on the cost curve. By stripping away that high-cost capacity, management ensures that when the cycle finally turns upward, the operating leverage on this optimized portfolio will be massive.
Right, they capture a much wider spread. But looking at historical performance, we are clearly in a tough spot right now. Historically, North American lumber averages 15% margins.
And North American EWP has historically commanded massive margins, averaging around 29%.
Yeah, so today's 4% margin is, well, it's abysmal by comparison. We're in a trough. But here's the paradox. They posted a $61 million net loss on paper, yet they generated $192 million in actual operating cash flow in the second quarter.
It's wild, isn't it?
How does a company lose tens of millions of dollars while simultaneously adding nearly $200 million to its bank account?
It's the ultimate lesson in accounting income versus cash flow. It's driven by depreciation and working capital. West Fraser owns billions of dollars in heavy machinery. Accounting rules force them to deduct a portion of those asset values from their income every quarter.
Which drags them down to a $61 million net loss.
Exactly. But depreciation is a non-cash expense. They paid for those machines years ago. When you add that non-cash expense back to the bottom line, the cash picture instantly looks healthier.
And the working capital lever, because we mentioned they were eating higher trucking costs to move inventory.
Right, that's the second half of it. If you aggressively ship that lumber and collect the receivables, you convert that inventory into cash. Even at a thin margin, the cash enters the business.
So between adding back depreciation and pulling working capital levers, you generate $192 million in liquidity.
Yeah, even while the accountants record net loss.
And that cash generation fuels their balance sheet, which is basically a fortress.
Hmm.
They're sitting on over $1 billion in total liquidity.
Which is huge.
It's how they maintain their quarterly dividend of 32 cents per share. And they paid down $148 million in operating loans during the quarter.
What's fascinating here is how they are doing all of this, funding dividends, repaying loans, and they even deployed $159 million in CapEx year to date.
Yeah, they aren't freezing their projects.
Not at all. And they're doing it without stressing the balance sheet, even at the absolute bottom of the commodity cycle.
So what does this all mean? I think it really challenges you to consider the resilience of their financial engineering. They have ultimate optionality.
They do. They dictate their own timeline. But a fortress balance sheet is entirely necessary right now, given the external geopolitical threats bearing down on Canadian producers.
Oh, the trade risks. Yeah, we have to talk about the elephant in the room, the tariffs.
Right. First, you have the ongoing 10% tariff under Section 232 on softwood lumber imported into the U.S.
Which goes into effect October 2025.
Yeah. It's essentially border friction. It compresses margins for any board milled in Canada and sold in the U.S., which is exactly why West Fraser is pouring CapEx into mills like Henderson in Texas.
Yeah.
Mill it there, you bypass the border entirely.
But the 10% tariff is just the appetizer. Under Section 338, the U.S. just announced a 50% tariff on certain Canadian products, effective August 19, 2026.
A 50% tariff is the kind of headline that triggers massive sell-offs.
It is. But here's where it gets really interesting. When you look at the actual application, West Fraser's softwood lumber, their OSB, and about half of their MDF shipments to the U.S. are explicitly excluded.
Right, and just quickly, MDF is medium-density fiberboard. It's heavily used in cabinetry and furniture.
Yeah, so half of that is safe. According to management, this 50% tariff only applies to roughly 3% of their plywood shipments and 20% of their LVL, their laminated veneer lumber.
Right, structural beams.
Exactly. So on paper, they completely dodged the bullet. The direct tax burden is almost negligible.
On paper, yes. The direct exposure is incredibly light, but this raises an important question. The indirect exposures and downstream bottlenecks could still cause massive headaches.
Because supply chains don't operate in silos.
Exactly. If you're shipping tax-free OSB on a freight train, but those rail cars are shared with Canadian products that just got hit with a 50% tax, shippers might halt their routes. Suddenly, your untaxed OSB is stuck in a rail yard waiting for a locomotive that isn't coming.
Rail networks consolidating, that's a huge indirect risk.
And think about the macroeconomic ripple effects. If a Canadian competitor makes the plywood that just got taxed at 50%, they can't sell it profitably anymore.
So they retool their lines.
Right. They stop making plywood and start pumping out untaxed OSB or lumber to keep cash flowing.
Which floods the North American market with excess OSB, crashing the benchmark price. So West Fraser's margins compress, even though they never paid a dime of the tariff.
Precisely. You cannot drop a 50% tariff on a bilateral trading partner and assume the impact is perfectly compartmentalized. Management has to remain super vigilant about this.
Which brings us to how management is viewing the road ahead. With thin margins today and looming tariff disruptions tomorrow, how do CEO Sean McLaren and his team view the runway for the rest of 2026?
The most telling data point is what they didn't do. They left their entire 2026 shipment and capital expenditure guidance completely unchanged.
No cuts at all.
None. Leaving guidance unchanged means they view this as a temporary cyclical valley, not a permanent structural decline. They are very confident in their optimized cost structure.
And we can test that confidence against the macro data. There's a medium-term bull case built on a massive, multi-year U.S. housing supply deficit.
Yeah, following the 2008 crisis, the U.S. simply stopped building enough homes to keep pace with population growth.
Exactly. Combine that deficit with the demographics, this huge cohort of millennials and Gen Z entering peak home buying age, and the latent demand is massive.
The only thing suppressing it right now is affordability. Existing homeowners won't sell because they're locked into 3% mortgages, and new buyers are priced out by 7% rates.
But the physical need for the housing hasn't disappeared. It's just deferred.
Right. If we see interest rates normalize, the dam on that pent-up demand breaks. Builders will scramble to put up 2 million housing starts a year, and the pull-through for lumber and OSB will be astronomical.
But what if rates don't normalize quickly? What if new construction stays sluggish for another 3 years?
Well, that's where the repair and remodel, or R&R market, comes in. It provides a fascinating counterweight.
Yeah, the anchor statistic here is wild. The median age of the U.S. housing stock is currently 44 years old. Half the homes in the country were built before 1982.
If we connect this to the bigger picture, a 44-year-old median home age is the ultimate safety net for wood product demand. New home construction booms and busts with interest rates, but the R&R market is fundamentally different.
Because it's mostly non-discretionary.
Exactly. A 44-year-old house is likely on its second or third roof. When shingles fail, the OSB sheathing underneath gets water damage and has to be ripped out. The deck built in 1995 is rotting. Floor joists are sagging and need to be sistered with new engineered wood. You can delay a cosmetic kitchen renovation, but you cannot delay fixing a hole in your roof.
The sheer volume of aging homes ensures that millions of board feet of lumber are consumed every single year, regardless of new foundations being poured.
Yeah, it's a deferred maintenance cycle playing out across the entire continent.
Okay, let's pull all these threads together. You have a company intentionally shedding aging mills for highly efficient modern ones. You have an operational machine extracting $192 million in cash from a 4% margin trough. You have a fortress balance sheet with $1 billion in liquidity.
A massive 50% tariff that somehow misses their core products.
Yeah, and a macro environment defined by an undersupplied new housing market and an aging 44-year-old housing stock that desperately needs maintenance. That's the framework you have to use when you run your models. You aren't just modeling the benchmark price of lumber, you are modeling the operating leverage of a highly optimized portfolio just waiting for a macro catalyst.
Yeah.
But before we wrap up, I want to leave you with a final, forward-looking concept drawn from the broader industry sources. We haven't touched on it yet, but it could completely alter this sector over the next decade.
Yeah, this is a fascinating trend.
It's the rapid technological advancement and market penetration of mass timber in commercial applications. For a century, towering commercial buildings and industrial spaces have been built almost exclusively with concrete and steel.
But mass timber, these heavily engineered cross-laminated timber panels, offers a legitimate structural alternative.
Right, and it's significantly lighter and boasts a fraction of the carbon footprint of concrete. I want you to seriously consider the implications here. What happens to the global supply chain for lumber when the massive commercial real estate sector suddenly begins building high-rises out of timber to meet low-carbon mandates?
That's a sector that currently consumes almost zero structural wood.
Exactly. How does that entirely new vertical of demand alter the pricing power and volume runway for a scale producer like West Fraser 10 years from now? It's a massive structural shift that isn't fully priced into basic housing start models, something to mull over as you run your numbers. Make sure to follow the show for your daily earnings coverage.